Perfect. Good afternoon and welcome to this session on Treasurers as Risk Managers, Learning from the Crisis. Welcome and greetings to the speakers and the audience of the ACT Middle East Treasury Summit. The audience will be having a toolbar to the right of your screen with about session information, Q&A, polls, surveys, etc. And throughout the session, please feel free to submit any questions in the Q&A box and we'll try to answer these as we go along. We will be having polls this afternoon, and so the results will appear as a separate tab in the About and the Q&A sections, and you will then see the polling results by me copying the results into that, and we can then discuss those. The session will be recorded today and will be made available for replay on this event platform shortly after the session finishes. Without any further ado, I'd like to introduce my fellow panelists here. Anish Jain from EFG, Stanley Poloski, sorry Stanley, I can never get your last name right, I do apologise for that in advance, from GE, and Fatih Tokal from Yildirim Holdings in Turkey. If I can just actually now ask Stanley just to provide a brief introduction to himself.
Absolutely. Thank you so much, Toby and the ACT team for having me over. So I'm Stanley. I represent the treasury function for GE in the region. I am the commercial treasurer for the GE team spanning across all our businesses for Asia, Middle East, and Africa. I work with our banking partners and other financial institutions to supply an all-in holistic commercial solution to enable business wins. That's primarily my role.
Fantastic, Stanley, and it's great to have you here. Anish,
Likewise.
Just briefly a few words for yourself about yourself.
Thank you, Toby, and good afternoon from Dubai to everyone and all the participants. My name is Anish and I am part of Export Trading Group, which is a commodity trading company. My role at ETG is to look after treasury and corporate finance activities. As an organization, we are present across 49 countries and the role spans across managing banking relationships, liquidity pool, and ongoing cash management. Thank you.
Fantastic, Anish, and great to have you here. We look forward to hearing from you later. Fatih?
Yes, this is Fatih Tokal. I'm heading the Yildirim Group's corporate treasury and credit risk management for 8 years now. Yildirim Group, a very large, well-diversified conglomerate, very large conglomerate in the region. So I managed all relations with local and international financial institutions, and our team reached on 20 people, by the way. Very large corporate team in the region, I can say.
Fantastic, and Fatih, and welcome to you here.
Thank you.
Excellent. So the topic of today is really as treasurers, as risk managers, and what lessons that we've learned from the crisis. Obviously, over the last 7 to 9 months, right through all organisations, everyone's been asked to do different jobs, to take on different responsibilities, to face different challenges. No more so than treasurers and the treasury function, whereby we've been asked to look at a variety of different areas and industry concentrations. Anish, with the pandemic causing widespread disruption to many industries and with corporate defaults rising, especially amongst some of the commodity trading houses in Singapore and Dubai, how have you managed that at ETG?
Thank you, Toby. This is a very good question, and I think from our audience, people who are associated with commodity companies, whether it is soft commodities or it is oil and gas, they have certainly felt the bigger shock of this pandemic, because we have seen few companies getting default and going bankrupt in the market across Dubai, Singapore, and Europe, and in India as well. The fallout impact has been the banks have become extremely cautious, and a lot of banks have publicly announced that they will, for the time being, stop financing commodities business. As an impact, all the organizations have been impacted in the industry and having less liquidity. What we have done as ETG is to implement certain hard measures to ensure that we are managing this position to maintain our credit risk profile as well as liquidity in place. Uh, First and foremost, we have frozen all kind of new credits that we are providing to new clients. That effect means that we have started offering cash sales to our customers. The onboarded clients where we have been extending credit period, we have curtailed it down, and we have also reduced our VAR limits, which is value at risk. The second measure that we have taken is to start working closely with our banking partners and financial institutions to give them more comfort about how we are operating and how we are managing this kind of pandemic situation. Uh, we started a monthly series where we proactively reached out to all of our banks globally and updating them about each month's activity, that how our businesses are performing and how we are managing the situation in multiple countries where we operate. And third thing that we have started is to build up a strong pipeline for doing new fundraising, because it was never certain that which bank would like to curtail the bank limit. So very start in the year, which is around February and March, considering the early signs of COVID, we started building our new fundraising pipeline so that we are sufficiently funded during this time. So these are some of the measures that we have taken, which has helped us to still remain relevant in the industry and market in last 8 months. And I'm happy to also share and report that we have done exceedingly well in last 6 months, given our performance in the market. Back to you, Toby.
Perfect. Thanks, Anish. There's some interesting topics there. You're talking about value at risk. Do you actually measure that on your customer portfolio, or that's just a generalized concept that you're looking to get your heads around and to work into your philosophy and policies?
Thank you, Toby. And this is a very specific measure that we allow as part of our performance management metrics. We have a specialized risk team which allocates value at risk to each of the businesses, commodities, and to the region. And certainly the client credit risk or market risk is part of this VAR limits allocation. We have implemented specialized software which allows us to see the measurement of VAR limits on daily and weekly basis. And then we do the testing of these VAR limits against 3-day, 5-day, and 10-day interval level at a 95% confidence interval. So this is a very specialized methodology that we have adopted, and so far it has given us good results to manage that kind of risk, which is associated with different factors in the market, be it market risk or credit liquidity or FX risk.
Oh, perfect. It's very unusual for anywhere in the world to hear corporates doing that, and so congratulations. I'm just not sure if the audience have seen the first polling question. Sorry, I'm running with some technical difficulties here, but the first polling question should be either coming up or it has come up, and that was: has your company increased its emphasis on cash and liquidity management in light of COVID-19, or has it been business as usual? The three answers that you could have possibly put was: yes, we have increased our emphasis; no, it's business as usual; or 3, we have diverted resources to other areas. So hopefully that will come up now, and then we can discuss the results of that just after we've spoken to Fatih. So Fatih, the question there for you is, with the recent troubles with the Turkish lira, which have been well publicised and published, and over the weekend we saw the departure of the head of the central bank, is this something that will impact you, and how will you deal with this on your receivables program?
Actually, we had a very dynamic news feed about the Turkish lira over the weekend. As you mentioned, initially, Central Bank of Turkey governor has changed and the minister has resigned. It was unexpected matter for the Turkish economy, by the way. Even though resignation hasn't confirmed officially yet, but Turkish lira already jumped against the dollar. So But the new governor has published a statement this morning. Central Bank of Turkey that they will take the necessary actions to stabilize the economy, and communication with the investors and with the parties will be stronger. When we look at our group, we are very diversified in businesses in 52 countries, and various sectors has created. We need professional treasury management. Within our financial risk management governance, we regularly assess, monitor, execute, and report all our financial risk, FX risk, interest risk, and commodity, by the way. Our operational inflow and outflow structure, liquidity, funding, currency are all key factors for our risk management procedure. And also, our group also 90%, almost all revenues, 90% is in hard currency, and loan structure is in line with our inflows. So we can easily, strictly assess the monitors and currency breakdown of the revenue and other loan balance of the stabilizer of the balance sheet, and it is naturally hedged, we can say.
Okay. Yep.
Yeah, just we have. Lastly, I can say that we have, for cheapening reasons, we for borrowing our cost, we use the cheapening things, and it's $3 billion US derivative transaction were executed for hedging purposes. So we don't have any FX risk and other things. Thanks.
Perfect. Sounds like you have quite a sophisticated program there, Fatih. And if you're managing to have a natural hedge position with your receivables book and your loan book, then that obviously gives you a lot of synergies.
That's right.
Perfect. Stony, from GE's perspective, you're obviously selling into large, multi-scale multinationals and GREs. Have you had any credit-related issues, and do you see that there are more and more demands being made of treasurers around the receivables and working capital management space?
Toby, on the working capital space, I'm going to just zoom out a bit and break this into three different buckets. Initially, when the pandemic hit us, we saw short-term reactions with a lot of procedural issues. Folks not coming to office, documents can't be couriered, signatures on documents, and so on. Now, the market and our banking partners found means and methods to overcome these constraints. And today, I believe these short-term concerns are very well managed. Okay, so that's out of the door. The systemic issue in this region, especially prior to even COVID, has been the oil prices. And now, coupled with the pandemic, it is a concern in the region. Now, from a GE standpoint, candidly, we have not seen credit defaults or credit concerns on existing projects. However, when we talk about new projects, we're clearly seeing customers planning better, delaying decisions, and hence the need for us to work on solutions towards AR, deferred monetization structures, is the need of the hour. The need for us to work with more local banks, more local institutions, to leverage solutions which don't add to our balance sheet, but more off-balance sheet treatments. One other theme I'll leave back here, Toby, and an interesting one for us as a company, is today, also because of the pandemic, working capital no longer is just a treasurer's issue. The companies recognized that we've got to work on working capital, a better management of working capital through better management of inventories, bringing in lean principles in production, reducing bottlenecks. So practically, as I said, the working capital ownership today is spread across the organization and not just with treasury, and that's been fantastic.
Just picking up on that though, Stanley, how do you actually involve the rest of the business in that? It's always one of those things trying to get the operational guys to buy into the working capital story. So unless they have ownership of that and they have some skin in the game, it's very difficult for them to drive inventory levels down or to drive improvements in their manufacturing processes.
Absolutely. Working capital turns or working capital management is now a broad-based theme across the company. And to give credit to our leadership, it's not that this came in just at the COVID time, it came in much before. As GE was embarking on its transformation journey from late 2018, this has been a part of our DNA. So everyone in the company today, operational or someone in the production side, talks working capital management and understands what they are doing towards improvement or worsening working capital management. Absolutely.
Perfect. And I think that's a lesson for all of us to learn in terms of that broad brush approach in terms of how we can get broader buy-in for the working capital side. So I'm going to ask Stanley, are you able to see any of the polling questions come up? I can't see that on my phone.
Yes. So, Toby, the question which you put out was whether there is more emphasis towards working capital management and so on. I think the answers which we have got here is 83% of the participants here have said that it has increased their emphasis towards this specific aspect of business. 17% of the group says it's business as usual, and we've got no one in the last bucket. So yeah, the majority of the groups does believe that there has been an emphasis on this particular aspect.
Perfect. So that reaffirms just, I guess, what the three of you were saying is that there has been a greater emphasis right across all businesses about the working capital management side of it, things about making sure that the receivables programs are secure and that unlike the previous crisis of 2009, where it's more about cash was king, this is more about liquidity, it's about working capital, it's about balance sheet and business resilience. And that's the main difference in I think the themes between this year and what we certainly experienced in 2008, 2009. If the team could put up the second question, and we'll start the general discussions. The second polling question for the audience then is: do you think companies are doing enough to strengthen their balance sheet resilience through exploring all sources of funding instead of relying on plain vanilla bank loans and financing? You have three options again. One is yes, we are doing enough to strengthen our balance sheets. No, we're not doing enough. Or the three is that we're not really sure one way or the other. Just while we're waiting for those questions to come in, Stanley, again, staying with that theme of balance sheet resilience and liquidity, what actions have you taken as Treasurer to ensure that you're managing your liquidity profile, both in the short term and given the likelihood of the pandemic reaching well into 2021 in next year as well?
Toby, going back to how I ended my previous question, is we've started this transformation journey in 2018, and a lot of our actions from a liquidity perspective has been centrally at the top of the house. Now, as a part of that exercise, our focus has largely been on reducing our leverage, and again, as a part of that too, we've sold a part of our healthcare business in late 2019, proceeds of which came in 2020 early, around $20 billion of cash. And this cash, if I may say, came in just at the start of the pandemic. So practically speaking, using this cash and using the actions which we have gone through, we've ended our third quarter with $39 billion of cash. Year to date, we've reduced our debt by $11.7 billion. And since the beginning of 2019 till date, that number of debt we've reduced by $25 billion. So really reducing our leverage at a time where most players are shoring up on debt has helped us create an extremely strong balance sheet. And all these actions, as I said, are global actions. Locally, our focus has been more at a deal level to ensure that at every deal, we are cash positive, and also to ensure linearity of cash. And linearity is a very interesting concept. As treasurers, when you look at only quarter-end milestones, you tend to ignore the time frame between these quarters. And this is something which we are focusing on, to drive cost efficiencies, to not go to the market to borrow in the middle of the quarter and pay back at the end of the quarter. So that's been primary. Again, very micro level, we've optimized all our liquidity structures. We've ensured that we have visibility to the extreme last dollar in the region. And clearly, the understanding or the culture in the organization to understand that revenue and profitability are important, but cash flow is what brings revenue and profitability home. That understanding today is immensely appreciated in the organization.
I think that's actually quite a valid point, is that having been in the region now for some time myself, I've never actually really seen a lot of corporates start talking about free cash flow to equity or free cash flow to firm, and all of a sudden I see that terminology and that metric creeping into a whole raft of discussions, which is pleasing to see. But it's now more emphasis on that cash flow, on that free cash flow, and in terms of what you can do with that. So I guess, Stony, it's one of those age-old principles that you never waste a good crisis to get your balance sheet in order and to deleverage.
Precisely, and it's going back to the basics, right? Fundamentally, at some point of time, without doing too much engineering or looking at exotic structures, just go back to your basics. Yep.
Stony, can I just ask you if you can see the polling results come back from that last question?
It's on the way. Okay, so if Toby, if you could repeat the question again.
So the question was, do you think companies are doing enough to strengthen their balance sheet resilience through exploring all sources of funding instead of relying on plain vanilla loans and financing?
So 47% of the audience doesn't feel that the companies are doing enough. 33% of the audience thinks that they are doing enough. So clearly a lot of area to flex and work on. And 20% of the audience really is unsure. They probably are not in the space to have visibility towards what actions the company is taking. So 47, no, 33, yes, and 20 unsure.
Fantastic. Well, look, maybe we'll come back to that after we've spoken to Fatty for one moment, and we'll see if we can actually provide some better guidance then for that 47% or that 20% that's not sure. Fatty, many corporates have found themselves in a liquidity crunch as a result of business volumes being depressed and traditional sources of funding drying up. Yildirim Group has an interesting perspective on this, given your unique positioning as being a Turkish headquartered company with global sales. Can you share some of your insights around your approach to managing the relationship with your banking group and how you've diversified your risk around funding and loan attraction?
Yes, thank you for asking. It's a very interesting question, by the way. Headquartered in Turkey and with a very large and global sales we have. Actually, we have a very large diversified of funding options in our hands. Now we reach almost 60 banks globally, especially the European top banks, Swiss banks. We have financing lines for revolving credit facilities, stock financing, warehouse financing, borrowing-based facilities, and we do project finance, ECF finance, and also we have met with the strategic investor, and we can achieve that they will be an investor. I would like to say that the transparencies are one of the most important practice in our bank relations. We contact with our banks, and so every transaction, we contact with the products in trade finance. We diversified the trade business, and we improved our trade finance arm. For example, structured commodity trade finance. We finance the goods in warehouse, plant, and also the majority of sales are credit, all insured. we use forfeiting, we use discountable LC, and also additionally, we have extended our financing terms by predicting that the market will be squeezed in COVID-19. Recession may occur in a couple of months. So we turn to medium and long-term financing models for pre-export and import financing, such as 3-year, for example. It's really high in this region. We do the promissory notes discounts, and we use the Exim Bank working capital loans. For receivable side, we may say 80% are receivables and export. We do 20% domestic receivable. So it's all guaranteed. Toby?
Yep, no, perfect. No, sorry, I'm just there. I was just adjusting my camera. Fadi, it sounds like that you have a full-time job just managing those banking relationships. 60 banks globally. Exactly. With those sorts of structures, it sounds like a textbook case for an ACT exam, I think.
Right.
Fantastic.
Yeah.
And certainly, picking up on that, Anish, you spend a lot of time updating your bankers on a monthly basis. What sort of questions have you had from your bankers so far about the balance sheet resilience and what you're doing to protect that? And are you seeing a different level of expectation from these banking groups today around disclosure requirements or tightening of loan covenants?
Yes, I think it's been a very interesting journey in last 6 months, because we have seen banks coming and asking questions which are sometimes so basic, and you ask yourself and you ask the banker that you have been extending a credit facility from last 5 years, and if you are asking such questions to me now, that means you had no clue what you have been extending credit for. But with all due respect to our banking friends, this is also a factor where banks would like to reinforce and reconfirm what they are partnering with the corporate. We don't have a big balance sheet, or we don't have a big loan book, as Stanley mentioned, about billions of dollars, but considering whatever size that we run, we do share with Fatih that we have around 40 banks and we have around 15 DFIs on board with us, who provide us combinedly a little over $2 billion. Considering our case of business, where risk management is a very key important element, because in commodities business, if your risk management is poor, the traders can tend to lose money very quickly. So keeping that kind of a risk associated with the business, the kind of questions we have seen from banks is hardly towards balance sheet, but it is more towards P&L and risk management. Everyone wanted to know what kind of open positions you are carrying, whether it is commodity related or it is FX related, what kind of risk management practices you have, how you are ensuring that if tomorrow the market changes by another 2% or 5%, what will be the impact on the P&L and the balance sheet. In addition to this, they wanted to understand what is the management guidance in managing this kind of a COVID impact in various commodities and various markets. So as Fatih mentioned about transparency, I think it is definitely one of the most important elements to have a very open and constructive discussion with banks, to tell them what is happening and give them regular updates. I think me and my team have been spending close to 50-60 hours on a weekly basis, providing feedbacks and updates to various banks. And so much so that we have divided that 3 or 4 members have been regularly updating the status updates and sharing open and transparent communication with the banks. And just to answer your second part of the question, sorry, Toby.
No, I was just going to say, just before you get onto that, Anish, and that's often a part of the Treasury work that people don't see, that management doesn't see. They see the results in terms of the ongoing balance sheet support or lending support or trade facility lines, but they don't necessarily see the hours and hours that goes into it behind the scenes in developing those relationships and those partnerships.
Yeah, you are right. So we have kept some windows open to let the hot air pass through. And in few of the calls where we have some large accounts, we have included few of our senior management people on board to be present on those calls, and they can experience what we are going through. So that way, the senior management was fully updated what is happening in the market, and it also helps them to manage their own expectations from the treasury team, because as you rightly said at the start of the session, that the role of treasurers have become even more increasingly difficult and challenging with this pandemic hitting all of us. So that way we have kept the communication open. And I was about to answer your second part of the question in terms of making the balance sheets more resilient and looking for diversified avenues of fundraising. I have certainly seen in the commodity markets that companies and big and small and even mid-sized players, they have been harping to get the capital in whichever form and manner they can get, because liquidity is the king in these days. I have received feedback from many of our large banks in Europe or Swiss, where they say that the corporates have been maintaining unutilized facilities of 150 to 200 million dollars, and over a period of 2 weeks they have just drawn down on those facilities, because it's not that they need it, but they drawn down just to have a liquidity buffer with them available. So those kind of things we have seen very unprecedented, which has never happened, at least in my career of last 18-20 years. I have not seen that.
Yeah, and I think we saw a bit of that in the UAE in the start, and certainly in March, April, May time, where there was a lot of liquidity sucked out of the local banking market as corporates and GREs did exactly the same thing here. If we can move to the third polling question now, which was COVID-19 has brought a new way of working to Treasury and in turn created new stresses and pressure points. Are you actively taking measures to ensure that operational risks are managed and your team's mental health and well-being are being looked after, or do you think you could do more? 4 responses for this question. 1, no, we haven't thought about this and don't see it as a challenge. 2, no, we've not yet actioned anything but plan to do so. 3, yes, we have some policies and strategies in place. And 4, yes, we have a wide-ranging support program. Fatih, you're back in the office. How do you think your teams or do you think your teams were well equipped to work from home? And how have you tried to ensure that your operational risks were managed appropriately whilst you had your team working from home and remote working?
Toby, I should say that it's our treasury operations, well-equipped treasury team, and also we have strict internal procedures to manage the operational risk. We had taken our measures and complete the risk matrix before the pandemic. So we use also the digitalization in our daily works. For example, this Kriba Swift, and SAP Treasury Risk Module, and also the Kriba Cash Management Module, Payment Module. So these are the digitalized treasury management systems that we are using now, by the way. It helps really a lot to manage all the system, all the structure.
Perfect. Hello? And your preparation beforehand, though, obviously must have been very good to ensure that those operational risks were continued to be managed in that way.
Exactly. Yeah, that's right.
Perfect. Anish, how have you managed the increased cybersecurity risk associated with working from home, and has your team adapted to the new norm?
I think from our side, cyber threat or beefing up our cyber security has never been a challenge. Most of the work has very easily been managed for those limited number of weeks when teams were working from home. It's been now a couple of months that we are back in office, although with reduced capacity, but Treasury team has been given advantage to work mostly from office given the nature of work that we handle. Maybe I would like to just spend a few seconds talking about the employee health and well-being that you have also asked a couple of audience to really comment on. And a very good exercise that we have done as part of our corporate communications team is to launch a series of employee well-being, where a weekly communicator goes out and talking to people about various avenues, that what they can do when they are working from home, how they can keep their well-being up, and how they can make sure that they are mentally fit as well. So this series has received very good accolades from various parts of the world. As I have mentioned, that we operate across 49 countries, so we have a very diverse pool of people coming from different cultures, and that kind of a series has really helped us to connect with the employees and make sure that employees feel that the company is also taking care of them while we are going through these challenging times.
Perfect, and that makes all the difference when you do have your workforce working remotely, is still to have that connectivity and that connectiveness back to the corporate. So, congratulations to you and the team. Stony, if I can impose on you just to have a look at those last results for that last question, please.
Absolutely, Toby. So this is not a surprise at all. We've got 64% of the audience who have policies and strategies in place already. We've got 18% of the audience who've got a wide range of support programs in place. And 18% of the audience have not thought about this as yet and don't see this as a challenge currently. In the last bucket, we don't have anyone. So the minority really is the no with 18%.
Yep, excellent. Oh, and I think that goes to show the evolution and certainly the forward-looking aspects of not only the audience here, but what we see in the UAE, where and the wider GCC and Middle East, where there really is a view towards more acceptance of mental health and well-being generally in society, but more importantly around this work from home phenomena. Stoney, I would imagine that GE would have well-developed policies and programs aimed at employee mental health and well-being. Can you tell us a bit about some of the strategies that you've employed?
Absolutely. So I've, beyond what Fatih mentioned and Anish mentioned, one of the important things which we've tried to do is leave the decision on coming back to office to the employees and truly to the employees. We've not enforced this at all. The offices, though, are open for people who do not have the infrastructure at home to continue working. And we've tried to lead by example. So leaders have been, in fact, told specifically try not to come into office, because when you come into office, you put pressure on your employees. Though you may say that you don't need to come to office, but they watch your action. So a lot of the leaders have been told specifically to try and stay away from office so as to lead with example. The other three elements here is a lot of the people in this region, especially in the UAE, are expats. People who have left home. Though everything may be rosy in the country, the need to check back on how's home by HR is an immense effort taken within the company, especially for those who are single here. Who don't have family here next to them and who are worried about people back at home. So regular calls, regular mentoring sessions, set up in place for these employees in particular has been primary. And eventually, creating leadership sessions and regional connects by inviting speakers from outside, external speakers, and having sessions to talk about resilience, not only on the balance sheet side, but on the personal side. Look at crisis, not only from a company perspective, but on a personal level, how to come out of these crisis situations and so on. The HR team has been doing a fantastic job to lead and create these sessions, clearly with the emphasis on heavy mental health and physical health for all employees. So, yeah.
Perfect. And I'd like to say that it's more by good management rather than coincidence, but I think we're just about out of time with about half a second or half a minute to go. Look, I think certainly, look, from my side, I've thoroughly enjoyed the discussion and thoroughly enjoyed hearing from Anish, from Stania and Fatih about your different perspectives on what you've experienced and encountered over the last 8-9 months. It's very difficult to come to grasp that we're nearly at the end of 2020, and I still have to actually shake my head to think what happened to the last 10 months. But I think it's just beholden on me now to say, gentlemen, thank you very much for your time, for sharing your insights with the audience. It's been not only intellectually stimulating and educating, but fun to boot. So it's been a great session. For the audience, get engaged with the ACT on social media, join the ACT's active LinkedIn group, follow us on Twitter, and tweet using hashtag ACT Middle East. There's plenty of room left on Twitter now that Donald Trump is not in the White House, so there will be plenty of bandwidth on that one. Watch this session again on demand. All conference sessions will be made available on replay on the event platform soon after it finishes and for the 30 days after the event. Continue the discussions and chat directly, and please pay a visit to the virtual exhibition hall. I think that's probably about it from us at this stage. Again, gentlemen, it's been a pleasure. Thank you very much, and I'll see you next time. Enjoy the rest of the conference.
Thank you so much, Toby.
Thank you.
Thank you.
Toby.
Cheers. Bye.